Most investors think the goal of a high yield ETF is simple: collect the income. But when I tested QLDY using full drip, 50% drip, and taking all the income, the results completely changed depending on one decision. And what makes this ETF even crazier is it pays distributions twice per week. That means compounding happens far faster than most investors realize. But there's also a catch, because if the share price drops while you're chasing yield, the outcome can flip very quickly. So today we're running a full QLDY backtest to see what actually happens over time, which strategy grows the portfolio the fastest, which one produces the most income, and whether this ETF is a hidden opportunity or a yield trap. Welcome back to Simply Money. Today, we're putting QLDY through a full backtest using three different strategies: our typical 100% drip, 50% drip, and no drip at all. And this one gets really interesting because QLDY distributes twice per week. That changes the compounding math dramatically compared to monthly pay ETFs, quarterly dividend funds, or even weekly pay funds. So we're going to look at portfolio growth, income generation, total return, and how reinvesting changes the long-term outcome. And honestly, the results were not what I expected, because one strategy clearly separated itself from the others. Now remember, past performance does not guarantee future results, and these high-yield ETFs can be extremely volatile. But this is exactly why I run these tests, to see what the actual math says instead of relying on hype. So let's dive into the numbers. Remember, this is not financial advice. This is for informational and educational purposes only. Please do your own due diligence and know all investments come with risk, including the risk of losing capital. Now, let's go ahead and dive into the worksheet. If you've never seen these before, this is our QLDY drip sheet. If you like this, you can get a copy of it down below in the description at Buy Me a Coffee. All of our spreadsheets are available there. And what we're looking at here is we have a date where we buy a hypothetical amount, and we're going to be looking at our typical $525,000 portfolio. But I am going to change that after we look at this for those who are unable to understand that the percentage is the same, whether we use a $500,000, $5 million, or $5,000. So we'll change that up in a little bit. This is a back test. This is using the actual data. This is not a hypothetical what if projection into the future. This is if you had bought at this time and then you just reinvested dividends, did not reinvest at all, or did it some sort of hybrid in between, what would the outcomes be? There's no additional funding of this. It's the one-time initial fund, and we're tracking how that would have performed. Now, dollar cost averaging does change things. And that is sometimes a good thing to remember, that dollar cost averaging, when the price is dropping, you're getting way more shares. So reinvesting, it can be beneficial with DCA, where if you're using the income, it is not as impactful on the dollar cost averaging. So some things to consider. We can't run every possible scenario in a video. We do different videos for different scenarios. This is a one-time investment into QLDY. What would it have done? We're looking at October 1st, 2025. The share price was $51.15. I have it here paying weekly. It's actually twice a week, and that is QLDY. This doesn't do anything. It's just there for looks, so don't get too worried about that. With that amount of $525,000, you would have got 10,264 shares. We're going to look here. You have down these columns, you have the date that the distribution was paid and what the share price was on that date. First thing I want to do is go down the share price. We started out at 51.15. As we come down and we're looking at this, you can see it's dropped some. And right now we're sitting at about $47.78. It has dropped about 6.5% over this time frame, and this is a short time frame. We're only looking at about 7 months here. So it's not a long time frame to be getting overly worried about a slight drop. You can see that it has gone down We saw it come down all the way down here. We saw it come down to $37 and it's bounced back up to $47. So those who are saying, oh, there's NAV decay, NAV decay doesn't work that way. It won't rebound if there's truly NAV decay. This is just following the market. There is some decrease, just like with any fund, whether you're buying Coca-Cola, you're buying SCHD, something that's even a low yield like that, still has whatever the yield is, the payments for that period, the share price will reflect that. That happens with all funds. And because you're getting twice a week pay, you're going to see that fluctuating. But because they're doing covered calls on this and there's a lot of volatility, you're going to see a lot of movement. And that's how they're able to generate these payments. There's what we want to look at next is the distributions. Again, twice a week, looking at 19 cents, 19 cents. I just want you to look down here this entire time frame, looking at 19 cents, got up to 20 cents and came down here about 18 cents, dropped a little bit to 17. We're going to keep coming down. It dropped again into the 17. It bounced up to 18 cents. And then when the price really dropped low, it went down to about 16 cents. And don't get too worried yet. Dropped down here to 15 cents at its lowest, got down to 14.42. And now it's starting to climb back up as the price is climbing. It's starting to climb back up again. Now you're at 18 cents. What I want you to look at, because people are like, oh, see, you're losing, your amount that you're getting paid is going down. What I want you to see is the yield is what they're targeting. Look at the current yield, whether the dividend distribution was 19 cents, you're looking at 40% distribution. Come down here where it's 1442. Look at that, 38%. So the distribution, as you can see, has bounced between about 38 cents and 42 cents. It got down a little bit here to about 35%, but it's come back up to that 40%. Over this entire time frame, it has averaged 40.13% yield. So the yield has been extremely consistent. Now we're going to look at the scenario here. What happens with the distribution? This column here, D, we have full drip, meaning whatever you got paid, you take this distribution times the number of shares you have, and you got this $2,000 payment, and that's biweekly. So you got another $2,000 payment. You got $4,000 that week. The next week, $2,000, $2,000. So you're getting this consistent payment. But what you're doing in this scenario is you're buying more shares. And we show that right here in this column where you see you added more shares. Now you're at 10,303, 10,343. So when you're getting this distribution, you're getting it against more and more shares. And I want us to come down as we look. The payment has been very consistent, right at $2,000. Hasn't gone down very much, hasn't gone up very much. It's pretty much been $2,000 every single pay time, twice a week. So $4,000 a week every single time. This is our lowest here I'm seeing at 1982. So that's a big drop. We had one up here at 2100. And then we have a couple down here as we come down. It got down to 1804, 1871. I think I'd be okay with that. It's a couple $100 short for the week, but you're still getting $3,700 for that week. And as we come down, now we got up here, you got up to 21, almost 2,200. Oh, now we're hitting 22, 2,300, 2,300. Because look at this, the number of shares you have gained in this short period of time, 2,869 shares that you're getting on average 17 cents per share. So you've added a ton of shares. The distribution has been pretty consistent. And as that price is starting to rebound a little bit, the distribution amounts going up and you're seeing your biweekly pay going up. Over the course of this time, it's paid out $131,000. You've reinvested that. Your portfolio here, your unrealized gains is up to $627,000, a $102,000 gain in this short period of time. And we're going to come over here. The second column we're going to look at is the 50% drip, meaning we take half of the payment and we reinvest it, and the other half we take as cash. So if I was retired And I said, I want to use this fund to live off of. I'm going to use some of the money, but I'm going to reinvest some to build up my share count to help offset when the distribution does drop slightly. So this is half of what you're getting. Remember, you're getting this payment twice, $1,000, and you're getting that twice. $1,000 you're taking as cash, $1,000 you're taking to reinvest and buy more shares, which we show here in the shares 50% drip. So you're getting more shares, but only half as many as the full drip. And as this goes down, the price isn't going to be exactly half of the full drip, because as you come down, you've only been buying half of the amount of shares, and that exponentially goes down because you're getting fewer and fewer shares compared to the full drip. Now, as you look at here, remember you're getting this twice a week. You're right at the $1,000, about half of the amount. Again, it's not going to grow quite as much because you're not adding as many shares per cycle. But again, very consistent, right at $1,000, no major drop. You're in the 900s here. We'll come down a little bit. You're pretty much in the 900, drops into the 800. Then we jump back up into the 900 range, and now we're back at the $1,000 range. Each pay period, twice a week, you're getting about $1,000. So every week, I'm getting about $2,000 for cash and about $2,000 I'm reinvesting. In this scenario, you've received $61,000 of cash to go and spend, to live on. And this is since October. So you're looking at, again, 6-7 months time frame here. That's a pretty nice, healthy paycheck. And if you look at your column J here, this is your balance. Your balance is up $29,000. So not only have you taken out a considerable amount of cash, you've also increased your unrealized gain, your portfolio balance. There was a few times it got down a little bit. Worst case here looks like about $425,000, but you can see you were able to maintain even through a little bit of pullback. Now, what would this do if it pulled back and stayed down for 2 years? We don't know. With a lot of funds, we don't know that, and we only have the past to go by. That's why we cannot predict what the future will be. And that's something to consider. But if you're flexible, and again, I would not go all in on this fund or any fund, but even if I had $50,000 in this and I wanted it producing me income, if I'm flexible, your financial freedom and retirement plan should be flexible. Shouldn't be, I'm taking exactly this amount every month. You need to have some wiggle room there. Some months, maybe you can take more and put that into your cash reserves. So when the market is down, you're not pulling quite as much out, and you can reinvest that and take advantage of that lower stock price to get more shares. So when it rebounds and you're getting those higher payments, then you can take out a little bit more again. A lot of different things you can do. Don't go into any of this type of thing and being rigid. In my opinion, you need to be more flexible. And this is what you're able to do with this type of scenario. Now, our final scenario here, and we're going to look at some other options in a minute, some calculators we have, so stay tuned. But our final distribution here is we're taking the full amount. We're not reinvesting any. We're taking it all, whatever it does. This is the number of shares you have, and we're living on that. So you can see, again, you get the exact same payment, but you're taking it as cash. You never get more shares than the ones you started with. You're taking the cash, you're spending it. You're buying more shares of something else. You're living it on it. You're taking vacation. You're paying your rent. Whatever it is you're doing with it, you're getting that for $4,000 a week. But how's that going to fare when the share price dropped and stuff? You can see it came down a little bit more. Now you're looking at $1,700 here. Here you're looking at $1,500. So you did take a little bit of a pay cut in this downward market. Now you're looking at $3,000 a week instead of $4,000. And that could be a big difference. If you need the full amount, that would be very difficult. That's why when you're taking these approaches, you need to be flexible. And during this time here is when I'd be like, okay, I'm not going to take the cash. I'm going to buy more shares, because look at these share prices. I'm buying more shares, so I'm going to reinvest during this time frame. And then when it comes back up like here, now I'm going to start taking more of the income again. So maybe I'm building my cash reserve. I have a bucket. So when the market's down, I can live off that cash. I can buy more shares when the price is down. Everybody's going to have to make their own decision, figure out what works best for you, and know what you're doing. So please do your due diligence. But in this scenario, you would have received $116,000 in cash, which is pretty nice over that time frame. But your portfolio is down about $34,000. Again, not huge, but in that short of period, that is a pretty nice bite to your portfolio. So that's where you want to make sure you're watching that. And you can see here you got down to 385 at one point, and that can be a little scary for people. Again, if this was a sustained lower market for a year or 2 years, we don't know how that would fare. Are you okay with $385,000 and only getting $1,500 every twice a week? You'd have to see how you'd fare in that. But your total returns with the full drip is 19%. Again, that's unrealized. That's pretty healthy gain in that short period of time. Annualized, you're probably looking at about 30% gain here, give or take. With the 50% drip, you're at 17.5%. And even with no drip, even though your portfolio balance is down because you took this $116,000 of cash, your total profit is 81,000, almost 82,000, which is a 15.5% gain. Again, in this time frame, that's very healthy. So it's something to consider. QLDY, again, what are your thoughts on it? Do you like it? Do you own it? Or have you thought about owning it? Leave me some comments below. Now, what we're going to do real quick, just look over here. For those that are interested, we have this calculator where you can plug in what percentage you want. I don't know why that's not yellow. That should be yellow. My apologies. There we go. That is yellow. And this one should be yellow. Those are editable. Those are where you put in the amount. So say here you say, I actually want to reinvest 40%, not 50%, or maybe I want to do 30%. You can set whatever you want there because you saw that taking the full amount, you lost a little bit of balance. So maybe you're like, okay, I'll do 25% or 30%. So we have it set at 40%. This is how much that you would drip. This is how much that you keep. And it shows your share count here and what your balance is. So we come down to the end here doing a 40% drip. Our balance is up 16,000 and we had a $73,000 worth of dividends that we kept. Again, you can change that however you want. Now this calculator over here, what we have is you put in the dollar amount. Say I only need $400 a period, so that's $800 a week. I need $800 a week. The rest I can reinvest. And so you can see here, by doing that, you had added $30,000 to your portfolio and you've received $25,000 of income. Again, maybe you're like, I need $1,000 a week. So I need $500 each period on this twice a week payer. Come down, you can see that you would have added 30,000 and you collected 32,000. This one's nice. This calculator is nice because if you're looking to use the income, you can be like, how much income do I need and what would this do? Now, hold on. For those who are like, okay, $500,000, I'll get the comments, maximum overload. You know who you are. They're going to give me the comments about their hypotheticals and how outrageous they are. So this one's for you. And we're going to put in $10,000. Here we go. $10,000. Look at here. Let's come down here. Exactly the same. Percentages don't change. Exactly the same. What changes is you're just seeing a dollar amount differently. That's why I created this for people to be able to put in whatever they have. You're right. Not everyone has $525,000. Not everybody's going to invest that amount into one fund. If you invest that kind of money into one fund, please leave me a comment below. We are interested in learning what you're doing and why you're doing it. But for those who say, okay, maybe I'm going to put 10 grand into this, I think that's about what I have. I'd have to look back at my sheet. But I did buy into this a while back, and I only have like $10,000 in this particular fund. So let's just look, and I'm fully dripping. We can look and see hypothetically. I'd have to pull my exact sheets of when I started. But if I had done on the inception date time frame my $10,000, you can see the yield continues to be the same no matter how much we put here. My $10,000 on full drip is now up about $2,000. I'm still up almost 20%, regardless if it's $500,000 or 10,000. That is what you're looking at. Now, if I was to say I wasn't dripping and I just needed cash, I'm looking at $76 a week. Nothing major, but that's nice cash flow. And it's about $300 a month of income that I'm getting off of a $10,000 investment. And if I was doing that, I would be down, my portfolio would be down to about 9,341. It wouldn't be anything crazy. It wouldn't be huge loss, but I would have taken out about $2,200. Or if I came over here, now you can see this is crazy because you wouldn't take out 500, but instead of $38 every pay period, let's say I just needed $30, put that in. So I'm getting $60 a week, $240 a month. At the end of the time frame, my balance is up slightly and I've got $2,000 that I could have used towards something else. So a lot of things you can do. This calculator allows you to play with that, play with the amount. When did you actually purchase it? You can go in here to the date. Let's say we didn't start until the first of the year and the price was $46.63. So if that was the case, my portfolio would be up a little bit more because I would have bought in at a lower price than when inception took place. So that's what you can do with this. That is our video for today. Thank you for joining me. Leave the comments down below on your thoughts, and we'll see you next time on Simply Money.